Good afternoon, everyone, and thank you for joining us on the Quest Trust Company Powerplay Tuesday. We've got a great one set up for you. We got Mike Zlotnick, who's coming to you from Tempo Funding, rather. So we'll be diving into that with Mike. He's standing by, ready to go. But before we get started, we're going to do a couple of quick announcements. First of all, as always, many of you who've been here before, you know that the purpose of our presentation today is purely that of education. We at Quest Trust Company, and really anybody involved in these matters for the most part, we're not providing anything in the way of tax, legal, or investment advice. Whenever you're doing your own self-directed investing, it's always incumbent on you to be doing your due diligence about who you're transacting with. And of course, it may be advisable before engaging in any investments that you do work with your tax, legal, or investment advisor before making that investment. Want to talk a little bit about, again, just the background of self-directed IRAs. Again, just as a recap, there's really nothing magic about the term self-directed. IRAs are going to be the same no matter where you go. They're going to be traditional, Roth, SEP. There's even the health savings accounts and the education savings accounts. Anything that is a tax advantaged account can be self-directed. Now, the difference is with the self-directed account, you get to choose what you're really putting it in. That's where the self-directed comes in. I'm saying I want to invest in this deal. It's not something that somebody is offering like Fidelity or Charles Schwab where you buy what they have. You are in control. You get to choose exactly what it is. And here at Quest, we concentrate in three primary categories of alternative investing. Real estate, which could be literally a piece of property. It could be a tax lien, it could be a foreclosure, but you could run an Airbnb through your IRA. Syndication deals under private entities is what we see a lot of too. That can be multifamily. Multifamily now could mean senior living, car washes, self-storage, you name it, it's out there. But it also incorporates things like cryptocurrency, private company stocks, oil and gas, those kinds of things as well. And then there's the private lending. Private lending, you get to be a hard money lender. You get to set the terms. You get to create all the terms of the interest rate, the term of the loan, points, securitization or not. You know, again, it's where you have the utmost in creativity about the investment that you can personally create. All right, well, we want you to take advantage of these things. We want you to take control of your financial future. And the QR code that you see there is the easiest way to get in touch with somebody like myself or somebody on the team. This is a way you can have a brief consultation and learn more about your options and about the different types of accounts. Now, I want to walk you through just a couple of things that are going on here at Quest real quick. Right now, we are doing a promotion for new account holders. If you open up your account now before the end of March, what we're doing is called our two-step promotion. What it means is you pay the account opening fee, but if you get that account funded with $2,000 or more by April 15th, you get a $125 credit to your account. Now you may be saying 125, what's the significance there? That's the cost of a transaction here at Quest. So basically what it means is that your first transaction is free. Next thing is we do also like to broaden the focus. We do now are going in on a presentation where we're going to start orienting some things toward younger investors, those millennials that are out there. They want to take advantage of this as well. So if you are a younger individual or if you're a parent and want to start inspiring your kids to start doing some of this investing, please make mention of this. Again, the QR code will give you the registration for it. Last is coming up. We have, again, our live events that are occurring this month, this will be in May. The focus is on veterans who have transitioned into becoming successful real estate investors. This is going to be held at our various offices in May. This will be in Houston, Austin, and Dallas. I'm coming to you live from our Dallas office, so we're looking forward to this. It'll be on the 17th or the 14th here of May in Dallas, May 2nd and May 7th, respectively, in Austin and Houston. Always love to see you there. These events are great. The attendance has been larger than ever. And again, part of what we do as well, in addition to the education, there's networking, there's deal pitching, there's food and drinks. So again, if you're in either of those cities, please, we hope to see you register and hope to see you there. Last, this is the year, everyone. Quest Expo coming up. We did it 2 years ago. It was a big success. We had about 800 people. This year, it's going to be hosted in Dallas at the Irving Convention Center. We're expecting a larger crowd than ever before. We're anticipating that we're probably going to have about 1,000 people from around the country. We're going to have vendors of all sorts, not just operators, but construction people, maintenance people, CPAs, attorneys, everybody you could conceivably see as being a part of your team for your investment purposes will be participating in this. And every element of self-directed investing will be addressed in main stage presentations, breakouts, panel discussions. We've got content that is already out there that we're developing, and we've still got plenty that we've got on the drawing board. And again, I think this is going to be one of the premier events coming up in investing in self-directed IRA space. So again, mark it on your calendars. And we hope to see you there in June here in lovely Dallas. You know, it's really, again, I think going to be a marquee event. All right, with that, we're going to start transitioning over to Mike. And again, we have Mike Zlotnick, who's here with us today. Mike has personally been in the debt and equity field as an investor in real estate since about 2000. His career goes back in IT, risk management, and just the overall development of complex systems related to software and any kind of processing. He became a part of IT, and he's always had a background in real estate as well, because again, in his view, he's always been able to see outcomes that are foreseeable and risk that is manageable. And I know that's part of what he's going to be talking about. Back in 2009, Mike joined up with Tempo Funding. He's become a managing partner and a VP in that company. Before that, again, he worked in a variety of different companies and locations throughout the years, but now is really embedded with Tempo Funding in a variety of different ways. Mike will probably tell you a little bit about himself as well. He's a math guy. He's from BYU. And again, I think he's got a lot of varied experience and is really going to provide you with a lot of great information today. So without any further ado, let me bring Mike on and take it away. Looking forward to what you have for us today, Mike.
Thank you, Steve, for the kind introduction and for the overview. And I can attest, I was at the Quest Expo pre-COVID, and it was awesome. It was just absolutely awesome. And obviously COVID broke things, and now you guys are coming back. So excited to attend. And I remember it was in August in Houston. It was hot. Hopefully Dallas is a little bit cooler in late June. So
well Dallas is cool, period. This is the office that I happen to manage here. So yeah, you can anticipate it's going to be a great event up here in Dallas. We're really excited.
Looking forward to it. All right, so we'll talk about maximizing IRA returns with mezzanine financing in commercial real estate. Wonderful disclaimer. This is for informational, educational purposes only. No solicitation of any kind, no advice of any kind. Before making any investment decisions, consult with your attorney and CPA professionals. And if you're interested in any of our funds or syndications, request PPM, private placement memorandum to accredit investors only. All right, now we can go to the meat and potatoes. Just a couple more words. I'm originally from Moldova, Republic of Moldova of the former Soviet Union. I left when it was still Soviet Union in 1989. I'm a political refugee from the evil empire, from the communist empire. I entered the United States as a refugee from the communist evil nation. And I've been a U.S. Citizen, a U.S. patriot. Graduated from Binghamton University in mathematics. And I live in Brooklyn, New York with my lovely wife, 4 monkeys and a cat, 4 kids and a cat. Been passive real estate investor since 2000 while I had a technology career. And then I transitioned to real estate full-time in 2009. And I assumed command of Temple family of funds and syndications in 2014. Been doing this for a while. It's both my passion. It's a journey. It's fun for me. I love what I do. And Temple runs a family of diversified funds and syndications. Happy to chat further, but let me dive into the presentation. And I have a podcast with a cheesy name. No, couldn't come up with a better name. I go as a Big Mike. People literally call me Big Mike. So I have a podcast called Big Mike Fund Podcast. If you're bored, you got nothing else to listen to, tune in. All right, so let's talk first a little bit about the shift in the monetary policy. So what you see here is a graph of the Fed funds rate that's spanning back to 1955. It's been a long time. And what you see in gray are recessions. So the Fed funds rate fluctuated over time. Some of you have heard, hopefully, maybe you have seen the inflation crisis of the 80s when the Fed had to push Fed funds rates from 10% to 20%. It felt like a huge rise in interest rates. And that's what Fed did, Paul Volcker, to fight inflation. It feels like we're dealing with a little bit of reoccurrence of inflation. And that's why Jay Powell pushed the interest rates up too fast and too furious in the recent past. And we'll talk about that. But before we talk about that, let us go back to the crisis of 2008. As you can see, there was a recession, a severe recession, a deep recession, and the Fed funds rate was dropped down to 0. And Fed started this fancy term, ZIRP, and it stands for zero interest rate policy. And they kept zero interest rates policy in place for a long time, from 2008 all the way until little past 2015. And they tried to bring the Fed funds rate up. They tried to hike, but they couldn't really get where they needed to get. And then COVID hit, and they had to react and respond, and they dropped the interest rates back down to 0. So we've seen many, many, many years of ZIRP policy. And just to be very clear, ZIRP is a drug. For those of you who don't understand how it works, they've accustomed us all to a very low interest rate environment. Some folks love it, some folks don't like it. And because it's a powerful drug that we're all addicted to, when the Fed withdrew the drug, in other words, they moved the interest rates up fast. That created a removal of a very addictive drug from the economy, and that has caused issues in the commercial real estate and other sectors. So we'll talk about that. So this graph just represents a short-term view of what I just described. So you could see Fed dropping interest rates during the recession that happened right after COVID, Q2 2020. When the COVID hit, everything came to a standstill. Economy shut down. There was a recession, a massive and fast recession. As a response, the Fed cut interest rates, and the government also went very, very aggressive on the fiscal policy. So just to be very clear, what Fed does is known as a monetary policy. They control the supply of money and the interest rates. The government, the Congress, spends money, and that's called fiscal policy. So as government printed trillions of dollars, unprecedented amount of cash, infused it into the economy to help deal with COVID shutdowns, they overdid it. And politicians love the sport of spending. The best thing you can give politicians is an incentive and a reason to spend. And I mean this with all due respect. So they spent like a drunken sailor. They overflooded the economy with cash, and then they put Fed in a tough position when the inflation started to pick up. Fed was sound asleep, and I mean this with all due respect. Jay Powell is a very smart man. At the same time, He's very slow to respond, and he took too long to respond, and inflation started to pick up. Whether you want to thank the Fed or blame the Fed doesn't matter. But the Fed had to move, and they moved fast. So if you could see, they start hiking in March of 2022, and over a period of a year, they hiked the rates by 500 basis points, and they did one more quarter in July of 2023. So it's really a year and 4 months, but most of the hikes were done over a period of literally just over a year. So it was too fast and too furious. And another really important thing, they've been keeping rates high. So it's not just the high rates, it's higher for longer. We'll come back to this discussion again and again. But the higher for longer is what's causing the issues for the economy. The economy that was accustomed to a zero interest policy for too long is now dealing with a fast adjustment. And in general, it is not a good practice to make rapid and massive moves. And that's what the Fed did. They made a huge move, destabilized some sectors of the economy, and we'll talk about this. Destabilization also creates opportunity. One person's problem is another person's opportunity, and we'll talk about this in a second. Just a couple of quick comments on unemployment and inflation, and then we'll move forward. So unemployment has been very, very low. As you can see, pre-COVID unemployment rate kept dropping. Then the COVID hit, unemployment spiked. Then it dropped post-COVID, and it's been at a very low level. And a very low level means below 4%. With the U.S. economy, unemployment being below 4%, it creates a situation where there's pressure on wages, pressure on inflation. I don't have it in this presentation, but there is a good old graph called the Phillips curve that symbolizes the relationship between unemployment and inflation. When unemployment is low, inflation is generally high. Very difficult to get inflation under control with unemployment being so low. So unemployment is still under 4%. The most recent print, literally the data just came out, it's 3.9%. So we moved up a little bit, but we're still below 4%. And now inflation. So here you could see what has transpired with inflation. As inflation accelerated, CPI ran all the way to 9.1%. And it was way fast. And that's when Fed started to cut. They started to cut a little bit earlier. As you can see, in March of 22, they started to cut. But at that point, inflation was already well over 8%. So they acted late, but they acted fast. And then the inflation started to calm down. But it's flatlined. We basically sort of stabilized at around 3 to 3.5% range. And it's pretty hard for the inflation to calm down. So the most recent print that literally came out this morning was the inflation in February was at 3.2%. It's actually a slight increase from January at 3.1%. So we're dealing with a sticky inflation. There's no better way to describe it. And this is another reason why it's keeping the Fed very slow to start cutting. They've already announced they're going to cut, but they're taking much longer time before they start cutting. And that has significant ramifications. But at least I wanted to paint the picture of what's going on with inflation, unemployment, and that now we will dive into what is happening in commercial real estate and what opportunity it's creating. So 2021 and 2022, those were the years where the economy was recovering fast post-COVID. And a lot of projects got financed. A lot of great opportunities looked like they were, a lot of interesting opportunities were there. But the checks written in the equity investments, in syndications, funds, and just one-off purchases, partnerships in 21 and 22 are now experiencing vulnerability. Some of these deals, or many of these deals, are sort of living on a thin ice, the best way to describe it, because the environment has changed rapidly once the Fed started to hike. So interest rates are high. It is known that the interest rates are high. In fact, Fed acknowledges they're called at a very high restrictive level. So where do the interest rates need to be? Well, the Fed's target is 2 to 3% inflation. So when the inflation is 2 to 3%, the Fed funds rate should be right around the same level. It should not be well above. But what is it today? It's still 5.25% to 5.5%. It's a well way too high, way too restrictive. So what's known as the interest rates are on the way down. It's been sort of acknowledged and admitted and projected. But when? When is the difficult question. And the uncertainty of this interest rate environment is causing complexity and difficulty for the commercial real estate. What we do know is that number of cities and towns have already experienced a significant correction in valuations of commercial real estate. And not even talking about office. Office is in terrible shape. Most of the office is just fundamental shift that was generated by COVID. I'm talking about fundamentally solid asset classes. So office is in deep recession by the fact of what COVID did to the folks not needing to go to the office. I'm talking about now multifamily, some self-storage, some industrial, and other asset classes that are fundamentally solid. So just to explain the difference, when you have a shift in demand for office space, that sector is in dire straits just because the shift is fundamental. Multifamily is still in demand. Open air shopping is in demand. Industrial, self-storage still in demand. So those asset classes are fine, but they're suffering from the interest rate changes. So some cities have corrected. Some examples would be Phoenix, Atlanta, Austin, Houston. Some of these markets valuations have dropped 30 to 40%. And as a result, some of these deals are not looking good. They're probably, some of those properties will be turned over to the banks as a foreclosure or cooperative transfer. Some deals may still have an opportunity to survive. But the primary issue, what's happening, the driver of or the outcome of these higher for longer interest rates is that liquidity pressure is building up on these deals. Why? Well, because most of the value-add real estate has been purchased or have been purchased or gets purchased with the floating rate mortgages. So floating rate mortgages simply means it's a variable mortgage. As Fed pushes their Fed funds rate, indices adjust, and the variable rate that investors pay on their mortgages adjusts. So as Fed pushed interest rates from 0 to 5.5, most of the variable rate mortgages got pushed just as much. So initial loans on these projects started with interest rates of say 4%. You add now 5.5% on top of 4, and you wind up with a mortgage rate of 9.5. As you can see, that change is so gigantic because the payment factor can double, even more than double as a result. And that's creating a lot of pressure on deals. This financial pressure is also creating opportunity. Some deals are in fundamentally strong markets, like Midwest, where there's steady Eddie markets and the valuations haven't dropped as much. They dropped 10, 15%. So these opportunities present still great real estate, but they need liquidity. They need additional cash to be able to pay the mortgage, to get these projects to the finish line, to finish renovations, and get to the point where they can refinance or sell. So this is what is creating the opportunities in today's markets. Again, just to be very clear, not all deals are worth the capital, but certain deals will be worthy the mass financing, and we'll jump into that. But before I do that, let's talk a little bit about interest rates outlook. And by the way, my guess is good as yours. I claim no crystal ball, or I used to have one. It broke and I can't find another one for sale. So I don't know when the Fed will start. I don't know how long they'll keep cutting rates, how fast they'll go. Your guess is literally as good as mine. However, I do have an opinion. And my opinion is that there are 3 possible scenarios. Scenario number 1, the interest rates will start moving down slowly. And what does it mean? It means that the Fed chair, Jay Powell, is likely to start somewhere around May or June, depending on the data. And then he'll move the rates down at a measured, slow pace, probably a quarter per cut, maybe 3 cuts, sort of. There will be a slow cuts environment. That's scenario number 1. That's the baseline. That's what it looks like now with inflation being so sticky. But there are 2 possibilities for the acceleration. So we start slow, but then inflation data cools. We start seeing real recession. Consumer has been pretty tapped. A lot of sort of softness in the economy where real recession will start showing up. and they'll accelerate cutting interest rates a little bit faster. And a third scenario where something is going to break, and it's going to break hard. So let me give you some examples. We're going to see a bunch of bank failures, and some of them already showing up. New York Community Bank, NYCB, which is a significant lender for commercial real estate, has seen a lot of volatility, and they had an emergency situation where they raised $1 billion in equity to survive. So we're going to see some of these situations coming back as a result of what's happening and the exposure to the commercial real estate industry. This is just one example. There could be other issues that will start show significant cracks in the ice, and the Fed will have to act. And something really, really important. Most folks don't understand. They ask the question, why doesn't Fed start cutting interest rates preemptively? Why don't they start now? And just to be very clear, last week had a great event. We hosted some of the smartest folks in the country, one of the most prominent, brightest minds in the countries. She's actually a frequent guest on Fox Business, Bloomberg, Fox News. She's a good friend. She told me this is not my information. I'm just a scholar just like you are. But she told me that Fed is really not in the business of practicing preemptive medicine or prophylactic medicine. They're in the business of responding to emergencies. Fed, Jay Powell is a surgeon in the emergency room. He responds when somebody gets shot. Somebody gets hurt, then they respond. So this preventive medicine is not in their line of business, but they will respond when things will break. So just to be very clear, it's a lot easier to respond, a lot easier to justify faster response when something happens. So commercial real estate right now is sort of in a difficult position, and most people get scared. Well, Warren Buffett said, be greedy when others are fearful, and be fearful when others are greedy. Commercial real estate has been corrected significantly. Can it correct a little more? Yes, but it's on the verge of a possible recovery. So the way to think about this, the opportunity to invest is not when everything on top. If you did that, then you're experiencing challenges now. But the opportunities may be opening up now when the sector is down. So recovery is what becomes an interesting opportunity. So again, liquidity pressures create significant opportunities to participate. Interest rates will normalize sooner or later. That's the discussion. Just a question when. And as interest rates decline, it will be music for the commercial real estate sector. So from that perspective, you got to be a little bit contrarian, and you have to be careful, of course. But the contrarian view in this environment may be where the great opportunities exist. Now, let's talk about mezz financing as a strategic opportunity. So on the left, you see capital stack. So if you're investing, the fact that you're on a Quest Trust company call means you're doing alternative investing. You probably know this already very well. I'm just going to explain it. If you don't, no worries. This is not difficult stuff to learn. So every investment in real estate typically has a capital stack. It's a fancy term explaining what happens, who invests into what. So when a bank loans the money in first mortgage position, first lien position, that's called senior debt. They're the first to get repaid on a sale of the asset, or if the asset doesn't perform, the bank is the first to take the property. After that, there's a possibility of a secondary debt or mezzanine debt. On some deals you see it, on some deals you don't see it. So, and my apologies, I have to cough out, so give me a second. Thank you. So mezzanine debt lives right above senior debt. It is in a secondary lien position, so there's some risk associated with that. It's not in first lien position, but relative to the preferred common equity, it's in a much safer place. So who is above mezzanine debt? Above mezzanine debt could be preferred equity and common equity. So not all deals have all four layers. Some deals just have senior debt and common equity. Some deals have senior debt and preferred equity and common equity. And some deals have senior debt, mezzanine debt, and common equity. And some deals have all four layers. So I'm just giving this as an example, typically on seniority on a capital stack. So why mezz debt is so attractive is that if a deal today is in need of liquidity, but the real estate is fundamentally solid. And you can go through the process and underwrite well and feel comfortable. You can write a fresh check. When you write a fresh check, you come into the deal and you push it right above senior debt and behind common and ahead of the preferred and common equity. Why is the case? Well, what happens on many of these projects is this. As projects start running out of liquidity. In other words, the capital that was raised previously, it has been spent. It's been spent to service the debt, pay higher mortgage payments. It's been spent on renovations, etc. Quite often, number of sponsors didn't expect the inflation to be so high and the cost of construction to be high. So there are other factors that impact the projects, but the financial pressure is by far number one. So in situations where the projects start running out of cash, often sponsors or syndicators or managers, they try to raise capital. And what do? They attempt what is known as capital calls. They go to investors and say, we're running out of cash. If we don't raise the cash, we're going to default on a mortgage. You, Mr. Investor, you invested in equity, $100,000. Now write me another check for $50,000 in the form of capital call. And they try to do it. And it's been it's been tried. And it hasn't worked very well. So I don't know exactly the industry standard. I've heard various anecdotal evidence that only about a third of the investors participate. The other 2/3 are either unable or unwilling. Imagine you invest in self-directed IRA money and you don't have any more money in that account. How can you write another check? You just can't. So it's either unable or unwilling to participate. Now, Mr. Sponsor still short 2/3 of the capital they need to get the project to the finish line. What do? They don't have too many options because the existing investors are not willing to give them any more money. The only solution is to go to folks that provide mass financing. Sometimes it's called preferred equity. So imagine you have a deal with just a senior debt and common equity, and sometimes the injection could be in the form of preferred equity. We like mezz debt, but some folks just call it something else, just to give you an example. So they come to these providers of capital and they say, help, it's a great deal. It's still a solid deal, but I'm running out of cash. Now the underwriting comes in, looks at the deal, and new investors say, well, we want to come in what is known as last in, first out. What does that mean? It means that they come in ahead of the common equity, ahead of the preferred equity. They're less money in. They want to come out ahead of those parts of the capital stack. The only thing they're behind is senior debt. Why it's important to understand is because as you're participating in mezzanine debt, you got to make sure the only thing is ahead of you is that senior debt. So the level of safety of mezzanine debt coming in here on the capital stack, coming in the low part versus coming in above common equity is much, much higher. So again, mezzanine providers, mezzanine finance providers are never going to come in behind common equity. In fact, they're making it a requirement for the sponsors and the existing investors to be pushed back. Because if they don't get pushed back, they will not participate in the deal. So this is an immense power to come in at a strong place on a capital stack and a relatively safer place. And I'm going to be very careful. It's still secondary financing. It's still not first debt. So there's some level of risk. But they can come in that mezz finance position, charge high rates of return, charge interest rates to the degree of 20%, sometimes even more, charge some points, even ask for some equity, because it is a recovery capital. This recovery capital is very opportunistic. It's not looking to be a vulture. I don't like to use the word, but in a manner of speaking, that money is coming in to provide critical liquidity for these projects. And of course, it needs strong rate of return. Some people will call it vulture. I don't call it vulture. I think it's fair. It's what the market bears today. So the opportunity in the mezz financing is significant on the right projects. So we'll keep chatting, but this is very, very important so you understand the principle of where the opportunity is to come in on these deals in this environment. So not all projects are worthy. Let me start there. Many projects actually not worthy. In fact, it's probably majority of the projects are not worthy. There are few projects that are worthy mezz financing. So what does it mean? It means proper underwriting needs to take place on these deals. And this is not for sort of amateurs. This is for professionals. There's, of course, risk involved, but it has to be done properly. And if it's done properly, these opportunities could be very strong investments on a risk-adjusted basis. And of course, in the underwriting, market and local economy plays a significant role. Who is the borrower? Who is the property owner? Who is the sponsor? Matters. Full due diligence has to be conducted on the documents, on the capital stack, et cetera, on the operating plan, and understanding the risks and risk mitigation. And just to be very clear, the money itself doesn't solve the problems. So there has to be a strong business plan with a very competent sponsor, and I believe that this plan can be executed and executed well. And when that plan is strong and the financing is strong, then there is an opportunity to invest and get this project to a great place. And from a budget perspective, one of the very important consideration, I've seen this again and again, sponsors come in with a minimal amount of money they think they're going to need. While in reality, when mezz lender underwrites, they want to make sure that it's the maximum amount of money they provide. In other words, enough money to buffer unpredictable outcomes, problems, additional delays, interest rates being higher for longer, et cetera, et cetera. So participation in the mezz debt typically needs to have strong business plan, but combine that with absolutely well buffered capital to get the project to the full stabilization and ability to refinance or to sell in a better market. Here's a case study. We actually did this deal. We love this deal. This is a very powerful opportunity. So let me just talk through. So in June of 2000, this sponsor bought a property in the depth right after COVID hit at a great price. Phenomenal price for a 996-door, large multifamily, Class A property, gated community in Indianapolis with 2 lakes, beautiful, beautiful community for a great price, little over $97 million. They've since invested over $20 million, and they're all in about $123 million. The first financing on this deal is about $117 million. This is the money that would be senior to the mezz financing that we're talking about. And the borrower, or the sponsor in this case, has come forward to us, asked for just a little over $7 million in the form of mezz financing. And we've looked at the deal, we've done our analysis, and we find the deal to be very strong. Why? Well, the current value of this property on the as-is basis, after the market corrected somewhat in Indianapolis, is about 160 to 165 million. At the peak of the market, the property was worth about 180 to 200 million. So it looked very, very attractive even after the price softened up with market correction. So if we can come in with $7 million above 117 and be all in, the last dollar about 124, 125 million on a asset that's worth 160, 165 on the as-is basis, and then the business plan is to get the property to 90, 95% occupancy. Right now, it's around 80% occupancy. It just finished all its renovations. So it needs a little more time to lease up because it's a big asset. It's going to take a little longer. So the result of this is that the future value in this property, after it's leased up and the market conditions improve, is viewed to be about 180 to 185 million. So a $7 million investment feels relatively strong. And the sponsor already executed the business plan where they push rents up from $736 on average per door to $1,263 per month per door on average. So the attractive opportunity here is, well, we're lending the money to the sponsor as a mezzanine financing with interest rates of 20% per year. We're actually charging 11 current pay and 9 deferred. 20% per year current pay would be too hard, but 11 and 9 is a reasonable balance. We're also charging him a couple of points, so we're asking for a little bit of equity. All that makes the investment really attractive on a risk-adjusted basis. The sponsor is highly experienced. They have a big footprint in Indianapolis and other Midwest cities. They have about $1.5 billion AUM. So this is a very capable operator. We've worked with him for years. In fact, with full disclosure, we actually have $3 million invested in the common equity of this project. And as common equity investors, we absolutely welcome this $7 million. Why? Because the $7 million borrowed to 20% per year for 2 years is going to cost about $2.8 million. Call it $3 million of the additional interest paid. But what does it do to the project? It takes the project to the finish line where it could be worth 180, 185. There could be an increase in value on this property by $10 to $15 million even more at a cost of $3 million. So as equity investors, we have substantially higher benefit to wait instead of trying to sell the property in this challenging market when it's not fully stabilized. So the power of this is immense because it makes all kinds of sense for us to raise fresh capital and invest in this deal as a mezz financing. Also for the sponsor and equity investors, it's a win-win-win for everyone because everyone wins with this type of a solution. So that's the key use case as an example, and we have a fund that does this investing. And again, I'm not allowed to solicit on the call, so I'm not doing that. This is not solicitation, but our fund wrote a check in the mezz debt into this because we think it's a great opportunity. That's all I'm going to say on this. So why is this a year of opportunity? So high interest rates provide for higher rates of return. Before the interest rate spiked, when you were doing secondary debt or mezz financing, you couldn't charge 20% even higher. In some cases, you can charge 21, 22%, etc. So the high interest rates environment enables investors to write a check at a higher rates of return. Number one. Number two, it can be balanced risk. If you understand where you're coming in on the capital stack, you understand who is the sponsor, you understand the business plan, and you have sufficient capital to get it to the finish line, on a risk-adjusted basis, this can provide equity-like returns without equity-like risk. That's the terminology we like to use. Because debt is supposed to be lower level of risk, but when you're getting these kind of returns, let's call them high teens and into 20s, it certainly feels like equity-like returns without equity-like risk. Equity upside. We're actually getting a piece of the upside, the piece of the promote on the property. That's kind of icing on the cake. We're not even counting for that. But part of the negotiation is that the sponsor has to give us a piece of their promote. Obviously, priority repayment. We're behind that $117 million is in the example. So, of course, you can't get ahead of the primary debt, but you're ahead of the previous invested equity. So you're taking that approach where there's a higher level of safety and a pretty well-understood risk. Obviously, steady income from the current yield distributions, plus the deferred yield gets caught up on exit. Typically, the exit means either sale or refinancing. And the terms could be negotiable. So the sky's the limit. As we see this opportunity, some will push back. Some of them will look at them and we say, listen, we love the deal, but we need some cross-collateral. Or we love the deal, but we need higher rate of return. So there's some flexibility in negotiation if you can do this and do it well. And at the end of the day, one of the most important strategies that we do as part of all our funds is diversification. So spreading the risk not between one or two assets, but multiple assets. Why? Because you never know. One asset might have a problem, two assets might have a problem. Diversification helps quite a bit to spread the risk. Why is it good for IRA investors? So high yield, very, very simple. Mezz financing pays significantly higher yield than primary debt. There's nothing wrong with primary debt. Primary debt is wonderful. But if you are in a level of comfort where you feel comfortable going beyond primary debt, so again, you could do a first lien note or you can do second lien loan. This is an equivalent of being in a second position. So if you're comfortable with the strategy, you can generate higher rates of return through the mezz financing. Obviously, it's income focused. If you're a passive investor, you want income, so works really well. Diversification, we talked about this. A couple of really important elements. There's no UBIT. So when you invest from your self-directed IRA, if you're investing in the syndication and you're writing an equity check, there's a risk of a UBIT, unrelated business income tax. But when you invest in debt, primary debt or mezzanine debt, in general, debt is not subject to UBIT. So it's a beautiful thing for IRA investors because there's no risk of a UBIT. It's secured by real assets, even though you're not in a first lien position, but you could be in second lien position. You could have either a lien on the property. You can have also pledge and assignment of beneficial interest of the entity. You can have essentially pledge from the borrower, the sponsor, or you can have another way to get the security is you can have a provision in the loan documents for a forced sale. If they default or they don't do something, you may have the right to force a sale of the property in a sort of liquidation sale. So all those elements create safety over or security instrument. No guarantees. There's of course risk in everything, but you have a security on the investment. And the loan itself could be short to medium duration. You're not loaning the money for 5 to 7 years. You're loaning the money typically on a deal where it's mezz debt, anywhere from 2 to 3 years, sometimes could be a little longer. Most of the deals today need to be prepared to take a little longer because the market is still going through changes, and the recovery may be a slow recovery. So in my view, 2 to 3 year time horizon is kind of the average you need to prepare for. If it takes 4 years, it takes 4 years. But if the deal is solid, you just got to be prepared that it may take a little longer. This is not a loan for 6 months duration. The project is not going to have enough time to get to the finish line in 6 to 12 months. It has to have enough time horizon to get the project to the finish line. That's about it. Just consider this as a part of your diversified strategy. Could be a good fit or not. Consult with your attorney and CPA professional. It's a very, very powerful strategy. Just a couple of other quick words. We're actually doing a panel of industry experts. It's coming up very, very soon. And it's a broad panel. You've got people from self-storage, multifamily, folks who do residential real estate, folks who do nodes, folks who do open-air shopping plazas. We have an RIA on this panel, etc. We have various industry experts. We are organizing this panel to chat about what's going on in the industry. If you're interested, go to templefunding.com/REI and sign up to learn a little more about industry experts' opinion through this panel. And finally, reach out to us. We appreciate you. We appreciate the opportunity to be of service. As I mentioned, we have our mezz fund that does this. We have other products. We have our income fund. Again, no solicitation. Just talk to Diana. Learn a little more. If it's right for you, we're happy to be of service. Appreciate you all. Thank you kindly.
All right, great. Thanks, Mike. Appreciate that. We got a little time left. We got about 10 minutes or so. I think we've got a couple of key questions that we want to make sure we address. First one comes from Michael Halliburton, and his question is, and I guess this might need the crystal ball that you mentioned, will there be an increase in foreclosures for the year 24 and then through 2025, do you anticipate?
Highly likely, yes, in the commercial space. So I'm not talking about residential. This is all discussion about commercial. Residential is a beast of its own. So in the commercial space, more and more pressure continues to build with higher for longer rates. And some projects will fail, and they ultimately will become either foreclosures or cooperative transfer of title from the borrowers to the banks. So the answer is most likely yes.
Yeah, I would imagine so. In terms of investment opportunity, I mean, how long would you say the window is here on something like this? Do you see the window being open for a while?
Yeah, it's another great question. The first question was great too. I think it's a couple of year opportunity. So for mezz financing to step in, basically it's a participation in the recovery. So we're still going to see some markets bottom out soon, some projects bottom out soon, and they'll be on the recovery. Some other markets may take a little longer. Some other projects may take a little longer. So because it's an evolving, rapidly changing market, I think it's an opportunity probably anywhere from 2 to 3 years where the bulk of the money could be deployed. But 2 to 3 years doesn't mean you got to wait for 2 years or 3 years and then write the check, because you don't know where the bottom is. It's one of the most difficult things is to predict where the bottom is. If you see a good deal today and it feels like a good deal, and that's what we saw in the deal Riverbend and Indy, we felt it's a great deal today, so we can write a check today. Some other deals may show up 6 months from now. Some may show up a year from now. But the bottom line is it's a probably 2 to 3 year lifespan of this opportunity to do mezz debt at these attractive terms.
Okay. All right. Hey, question that I get a lot from investors. It has to do with that capital call issue that you brought up. Can you just kind of explain sort of, I guess, to the investor what their thought process might be on participating in a capital call?
Yeah, it's another great question. It's a tough question. So we've seen people get capital calls and they're sitting and they're pulling their hair out and they're trying to figure out, do I do this or not do it? And it's tough in most of the situations today. The answer after full analysis is probably no. But you got to go through and ask for a lot of things, right? To do the decision capital call. So obviously you got to understand the current capital stack. You have to request forward plan for the next 1 or 2 years. Ideally, you're requesting for the plan for the full liquidity. How do you get to stabilization, right? So you got a CI operating plan and a financial plan. Now you also got to look at the valuation. What is the property worth today? So an example, somebody is requesting a capital call and the property is worth $100 million and the debt is $98 million. It's so thin, the equity is worth so little, probably not worth it. Even if the debt is 90 million and the property is worth 100, it gets tight. In other words, you're trying to protect. You also have to understand how much you're investing of new money relative to the old money, right? But if the property is worth 100 million and the debt is 70 million, then it's in many cases a no-brainer. So there's some no-brainer scenarios, some are difficult scenarios. The other really important consideration, and we've done this. People have come to us and some projects said, hey, we need capital call money. You know what's our response? Just learn this word, LIFO, last in, first out. I didn't invent the phrase. I came up with it. You gave me a little introduction. I spent 15 years as technology executive. I started my career and finished it as a technology executive. And in technology, in computer programming, there's a term called last in, first out. It's a fancy term, but this is how they call it data stack. Here is a capital stack. But the idea is identical. Is you basically, as an investor with fresh money, what you want is you want your money to be in better position on the capital stack. As a result, you can ask the sponsor, don't structure it as a capital call. Let's come up with a mass financing for the deal. And we will write you a fresh check if you can clear the underwriting. But we don't want to put it kind of adding the money in the common equity. We want this money to be ahead of all other common equity and give all investors same opportunity to participate. That's what is fair. Give existing investors and first dibs. Give them the first opportunity. Then if some of them are unwilling or unable, then you go to the external people. But the concept makes sense. So capital calls themselves, in my view, they're being executed, but a lot of them hit the resistance. And much better solution is mass financing, which I call last in, first out LIFO.
I think you're right there. I totally agree. And yeah, I mean, I see it all the time and I hear it, that people think if that capital call comes up, that it's just throwing good money after bad. So yeah, I mean, there's, that risk management I think is critical. I see one more question that came through and for a change, it's actually for me. The question is about charging fees on regular distributions from an IRA. I'm going to try to answer two elements of that because when I see the term regular distributions in my mind, I think it could mean two different things. If you're talking about a regular distribution from your IRA to you personally or to, say, another IRA by way of a transfer, the answer is no. There is no kind of fee related to that. If you're sending money out of Quest, the only type of fee you may incur would be based on how you send the money. By that, what I mean is if you're wiring money out of Quest, there is a $30 wire fee. If you send it by a check, there is a $5 check fee. But if you can send money that's leaving Quest through automatic clearinghouse, there is no charge. Now, the other way I interpret this question is when I see regular distributions back to the IRA by way of an investment like what Mike is talking about or anybody else for that matter. If you're talking about regular distributions and you're kind of talking about it applying to your account, to your investment, the answer there is no. There's no kind of fee associated with that. And, again, not to, kind of go plug Quest or disparage anybody else. That's an important thing to always look for in self-directed IRAs when you're now analyzing fees. I've seen a number of cases, and again, I would never point out or specify any company, but I've seen where, you know, fees may look lower on one end, but then they have like little embedded fees, like charging money that's coming in. And based on your investment, you know, you could see money coming in rather frequently, and that's going to be a fee that kind of adds up over time. So, Matt, I hope that answered the question. That does look like about all we have. And Mike, I do want to be respectful of your time and everybody else. So with that, I think this is probably a good time to conclude. You got your contact information up there, including the website, it looks like. Mike and Deanna, who, I don't know if you remember, Mike, we met a little while back. I think it was last year in Charlotte at one of the conferences, and it was great meeting you. But yeah, it's good to see you again. And yeah, why don't we take this as the point to conclude? And again, my name's Steve Sabaji. I'm the regional sales manager here in Dallas. And I want to thank you guys all for participating in our webinar and wish you a great day. And again, if you got questions, call us, call Mike directly. But we hope to hear from you again and hope to see you again soon on one of our presentations or live. Thank you.
Thank you.
Good night. Good night.